Good morning, everyone. As most of you are aware, the Bank of Canada surprised Canadians and our financial industry by increasing interest rates by 100 basis points or 1% this morning, Wednesday, July the 13th. The markets, analysts, and economists were expecting an increase of a half to 3/4%. So this extra 1/4% or even 0.5% more was definitely a surprise to all. And I guess I wanted to take a few minutes to go through what this means, where we stand now, and what this means for you individually and where are we headed. I'm going to go through a couple of slides here. Please forgive my technical ignorance. I was attempting to do a PowerPoint slideshow with a video, but it was too large to load. So I'm using an external video source here, and we'll just walk through a couple of talking points and go through things in greater detail. So first of all, what now? So prime moves from 3.7% to 4.7% with today's announcement. What does that mean for variable rate mortgage holders? Essentially that your interest rate will increase 1% with the increase today. What does it mean for fixed mortgage rates? As of today, nothing. Fixed rates were actually trending downward with some decreases being seen over the last few days here. So bond markets have not yet reacted in any direction. They've been basically flat this morning since the announcement. Moving forward, so historical numbers. So the caption here and the illustration is from a Financial Post article earlier this week. So what goes up usually comes down. And what this illustration here is intended to do is just to show the what happens after interest rate increases of steep numbers. So you'll see here all of these little peaks are followed by fairly steep declines at various magnitudes over the last 30 years. And as you'll see here on the far right-hand side, this illustration was as of yesterday, essentially, where the overnight lending rate was 1.5%. That moves to 2.5%. So obviously this blue line over here in the right-hand side is getting higher. And it will probably go higher here in September. But there is a peak, and I don't think that peak is that far out now. So that 1% increase that we saw today was surprising. It was more severe than what most, if not all, expected. But it's likely getting us towards that ceiling quicker. So the end result is, I feel, maybe negligible for the consumers, as we were going to be seeing another increase here in September. Maybe it's the same, maybe it's less, but I think that ceiling, whether that be in 2022 or 2023, is nearer. This slide here is, what do the experts predict? So this is taken from industry publication, essentially illustrating the 6 chartered banks, their chief economists, and their expectations on essentially the Bank of Canada rate in the coming years and the Bank of Canada bond yield, which is indicative of 5-year fixed rate mortgages. So if you just kind of look at this slide, moving left to right, so the target rate today moved from 1.5% to 2.5%. And you'll see here the predictions from earlier this week from all of the charter banks with kind of the top end of their target rate. So 3.25% being the highest predicted target rate over the next 2 years, which would be 0.75% more than today. Now, is there weight to these predictions? That's yet to be seen. We all know that economists and meteorologists are likely to be wrong. It's just by how much. So don't put too much weight in that, but I wanted to show it because even though that we received a surprising increase, we essentially were not that far out from what it would be predicted to be that top end. And then moving to the right-hand side here with bond yields and predictions there. Bond yields today are essentially sitting at about 3.15%. And then the 5-year fixed rate mortgages are priced off of that. Spreads today being kind of in that 2% range above bond yields, maybe a little less depending on the situation. So you'll see here the predictions for this year and the coming year, and those bond yields essentially are quite flat. RBC predicting some significant decreases, as is Scotia, and then some of the others are predicting modest increases. So what does this mean regarding fixed rate mortgages? We may have hit the ceiling, we may be plateauing, we may be coming down. It's all yet to be determined. but I don't feel that that 5% fixed rate mortgage today is going to be 7% in the coming months or the coming year. So I think that ceiling is near, and we're most likely to see some sloping off and decline once that is reached and we plateau. Points to ponder. So essentially just a few points here for discussion. So US inflation numbers came in higher than expected this week, 9.1%. That surprised, I think, a lot in the industry as well. These numbers are high as they are in Canada with 7-point-something% as well, but that does not mean that they can't come down reasonably fast as they are year over year numbers. And there has been obviously certain things in our economy that have affected that. So the war in Ukraine, Russia, ongoing uncertainties on the time frame, how that will affect world trade partners, commodities, whatnot, obviously causes some of its uncertainty. The post-COVID or current COVID lockdown still ongoing in China, and supply chain issues as a result of that and other global issues all give uncertainty to the markets and essentially our world economy. How does it affect things more locally to our market, to mortgage rates, to essentially qualifications? So variable rate mortgages will be harder to qualify for. This is government prescribed, but because the rates have increased, those qualification rates will move from 5.25% as of essentially today up to 5.75% to 6.25%. So essentially they're 2% above contract rates. You'll see fixed rates qualifying in the neighborhood of 7% today. So our government has built in plenty of, I think, wiggle room still to essentially assure Canadians that they can afford the given mortgage that they're qualifying for. How does it affect individual situations today for variable rate mortgage holders? $350,000 mortgage, just a hypothetical example. The payment on that with a 25-year amortization variable rate would increase $182 a month. So anyone who's looking to discuss their situation, what the options are for fixed rate conversion, please feel free to reach out. I will note that all conversion rates would be likely above 5% today. So if you know that your variable rate mortgage maybe is going from say 2.7 to 3.7, you're still probably 1.3 to 1.5 below what you might convert at in today's market. My last question is, do we reach the ceiling quicker? So I think there is a ceiling, as I mentioned earlier. This 0.25% additional increase that surprised the industry, I think moves us closer to that ceiling. The Bank of Canada meets again in September. What comes of that meeting, yet to be determined, but I think we're going to see another increase. And then I think most likely we see a settling as a lot of these interest rate increases take a while to filter through economic numbers, for consumer spending to be affected, for national and local housing markets to be truly affected. So I think it'll take a while to shake out. I don't think we need to panic based on the higher than expected rate increase today. But as always, please feel free to book a call. I'd be happy to discuss your individual situation, the options available to either convert your mortgage, extend amortizations, stay the course, lower your variable rate. Lots of options out there. And again, happy to take 10 to 15 minutes and chat and go through what that means for your individual scenario. Thanks so much for tuning in. Take care, and we will chat with you soon.